Welcome back to the channel, finance enthusiasts. Today, we're diving into some of the most influential tech companies in the world: Apple, Adobe, Fortinet, and Oracle. These industry giants have made waves in their respective fields, and we're about to take a closer look at their financial metrics to see how they stack up. So, let's get into the numbers and break down their strengths, weaknesses, and future potential. The P/E ratio is one of the most commonly used metrics to assess a company's valuation. It tells us how much investors are willing to pay for each dollar of earnings. Starting with Apple, its trailing P/E ratio stands at 34.63. This suggests that investors are confident in Apple's ability to continue growing its profits. Historically, Apple has been able to maintain a strong P/E, with a 5-year average of 28.91. While the current ratio is higher, reflecting the company's dominance in the tech space, it is something to keep an eye on for potential overvaluation. Adobe, known for its creative software suite, has a trailing P/E ratio of 27.68. This is lower than its 5-year average of 38.37, indicating that Adobe may currently be undervalued compared to its historical performance. Its forward P/E of 24.13 also suggests optimism for its future earnings, though slightly more conservative than Apple's. On the other hand, Fortinet, a leader in cybersecurity, has the highest P/E ratio among the group at 43.16. This high ratio signals strong growth expectations, which is common for tech companies in booming sectors like cybersecurity. However, with a 5-year average P/E of 53.55, Fortinet's current valuation is actually lower than its historical average, suggesting potential room for growth. Finally, Oracle, a cloud computing and database management powerhouse, sports a trailing P/E of 30.46, slightly higher than its 5-year average of 17.94. Oracle's forward P/E of 24.60 suggests that investors are expecting solid growth in the near future, likely driven by its cloud services and enterprise software offerings. The price-to-earnings-to-growth ratio is a valuable tool that adjusts the P/E ratio for a company's growth. It helps investors understand whether a stock is overpriced relative to its growth potential. A P/G ratio below 1.0 typically indicates that a stock is undervalued. For Apple, the P/G ratio stands at 3.63, which is quite high. This implies that despite its strong earnings, the stock might be overpriced relative to its expected growth. This is something investors should monitor closely. Adobe fares better in this metric with a P/G ratio of 1.73, indicating that it is more reasonably valued relative to its expected growth. With Adobe's consistent innovation in its cloud services and creative software, this could be an opportunity for investors looking for solid growth at a fair price. Fortinet has a P/G ratio of 3, suggesting that its high P/E ratio is balanced somewhat by strong growth expectations, but still indicating some overvaluation. Oracle's P/G ratio of 2.40 falls somewhere in the middle, reflecting moderate growth expectations and a valuation that's slightly on the higher side. Insider ownership is a crucial indicator of how much stake a company's management has in the business. High insider ownership can align management's interests with those of shareholders. Here's where Oracle shines, with a whopping 41.59% insider ownership. This is a clear sign that Oracle's top executives are heavily invested in the company's success, giving investors confidence in management's commitment to driving growth and value. Fortinet also stands out with 17.52% insider ownership, which is substantial and suggests that its leadership team is highly motivated to ensure the company's continued success in the cybersecurity space. Adobe has a more modest insider ownership at 0.41%, and Apple has the lowest at 0.09%. While these percentages are lower, they don't necessarily reflect a lack of confidence but rather the structure of these massive companies, where institutional investors hold a significant share of ownership. Continuing with some profitability metrics, the return on equity and return on assets are two critical profitability metrics. They tell us how efficiently a company is using its shareholders' equity and assets to generate profit. Fortinet leads with an impressive return on equity of 430.88%, a staggering figure that reflects the company's ability to generate returns on shareholder investments. Oracle is also highly efficient with a return on equity of 166.48%, while Apple is not far behind at 160.58%. These numbers indicate that these companies are generating high profits relative to the equity invested by their shareholders. On the return on assets side, Apple leads with a return of 30.59%, demonstrating that it is highly efficient in using its assets to generate earnings. Adobe follows with a return on assets of 18.19%, while Oracle and Fortinet come in at 7.82% and 16.9%, respectively. Apple's ability to extract high returns from its assets reflects its operational efficiency, a key driver of its long-term success. In contrast, return of invested capital measures how effectively a company is using its capital to generate profits. Fortinet leads the pack with a return of invested capital of 203%, reflecting its ability to turn invested capital into substantial returns. This is an excellent sign for investors looking at Fortinet's long-term growth prospects in the cybersecurity sector. Apple and Adobe also boast strong return of invested capital's figures at 61.72% and 32.34%, respectively, signaling that both companies are efficiently generating returns on their capital investments. Oracle comes in lower at 17.15%, but it still shows that the company is generating value from its capital investments. A company's share count can greatly impact shareholder value. Apple, Oracle, and Adobe have all been reducing their share counts over the last decade. Apple leads here, having decreased its shares by -7.20% compounded annually, followed by Oracle at -5.02% and Adobe at -1.24%. Fortinet, however, has maintained a flat but decreasing share count, signaling a different capital allocation strategy. Now, earnings per share or EPS is a key metric that tells us how much profit a company is making on a per-share basis. Adobe leads with an EPS of $17.90, reflecting its strong profitability and ability to generate solid earnings from its operations. Apple follows with an EPS of $6.57, which, while lower, still reflects its status as one of the most profitable companies in the world. Oracle posts an EPS of $5.77, and Fortinet trails with $1.92. However, it's important to note that Fortinet is still in a high-growth phase, and its EPS is expected to increase significantly over the next 5 years. Free cash flow per share gives us an idea of how much cash a company generates after accounting for capital expenditures, which can be used for dividends, buybacks, or reinvestment. Apple has a 14.16% free cash flow per share growth over the last decade, while Adobe boasts an impressive 22.76% free cash flow growth. Fortinet leads with 29.51% free cash flow growth, indicating its ability to generate significant cash even as it invests heavily in growth. Oracle posts a more modest 3.57% free cash flow growth, reflecting its more stable and mature business model. When it comes to dividends, Oracle and Apple are the only companies that currently pay dividends, with Oracle offering a 0.91% yield and 12.22% dividend growth rate during the last decade. Apple provides a 0.44% yield with a more modest 7.4% dividend growth rate. Adobe and Fortinet, on the other hand, currently do not pay a dividend, but with a free cash flow payout ratio of around 25%, it could potentially introduce a 0.73% and 0.63% dividend yield respectively. Additionally, their dividend growth potential could be around 15% annually if we look at their free cash flow growth over the last decade. Impressive, right? Continuing with margin ratios, operating margin and profit margin that are key indicators of a company's efficiency and profitability. Adobe takes the lead here with an operating margin of 35.93%, demonstrating strong operational efficiency. Apple follows with an operating margin of 31.27%, and Oracle comes in at 31.04%. Fortinet lags behind with an operating margin of 26.05%. In terms of profit margin, Apple in this case stands out with a whopping 26.44%, followed by Adobe at 25.59%. Fortinet posts a more modest 23.17%, while Oracle sits at 20.4%. All four companies' high margins are a testament to their robust business models, which generate significant profits from their operations. When we look at the evolution of revenue and earnings over the last 8 years, all four companies show strong growth, but there are some key differences. Fortinet has seen very positive revenue and earnings growth, which has been reflected in its market price. Adobe has also shown strong growth, although its market performance has been more in line with the broader market, VO. Oracle and Apple have both seen strong revenue and earnings growth but somehow flat. Their stock prices, in contrast, have overperformed compared to the broader market over the last 5 years. Debt is an important consideration when evaluating a company's financial health. Adobe boasts the lowest debt/EBITDA ratio at 0.53, indicating a low level of leverage. Fortinet follows with a ratio of 0.59, while Oracle has a higher ratio of 7.11. When we shift to debt/free cash flow, Adobe once again shows strength with a ratio of 0.62, followed by Fortinet at 0.63, Apple at 1.19, and Oracle at 7.71. These figures suggest only Oracle can be in trouble when we consider debt levels. When looking at stock price performance over the last 52 weeks, Oracle and Fortinet have both delivered impressive returns of 60.32% and 40.53%, respectively, outperforming the market. Apple posted a solid return of 26.56%, while Adobe lagged with a minus 9.91% return. Now let's look at the market caps. Apple is the largest company in the world with a market cap of $3.46 trillion, followed by Oracle at $487.07 billion, Adobe's at $218.08 billion, and Fortinet at $63.39 billion. Now, let's talk about the crystal ball moment, analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. Apple has a price target of $240.41, representing an upside of 5.56% from its current price of $227.55. My fair value estimates tell a very different story. For me, Apple is close to its fair value at $185.71, suggesting it is overvalued right now. Continuing with Adobe's price target is $612.02, which actually represents an upside of 23.54% from its current price of $495.42, indicating that analysts see the stock as potentially undervalued. And for me, Adobe, with a fair value of $509.36, appears currently undervalued. Now, Fortinet has a price target of $74.91, with a downside of 9.61% from the current $82.87. And for me, with a fair value of $61.54, can indicate an overvaluation of this company. Finally, Oracle's price target is $176.40, representing an upside of 0.34% from its current $175.77, with a fair value for me of $152.74, which is far from the current price and can indicate an overvaluation too. These valuations indicate that while there is some potential for growth, investors should tread carefully and consider these stocks' current pricing relative to their intrinsic values. So, there you have it. These four companies, Apple, Adobe, Fortinet, and Oracle, are all powerhouses in their respective fields. Apple and Adobe are highly profitable and efficient, with strong EPS and FCF growth. Fortinet stands out for its incredible ROE and ROIC, making it a top choice for investors seeking high-growth opportunities in cybersecurity. Oracle, while more mature, offers strong insider ownership and solid dividend payouts, making it an attractive option for more conservative investors. Each company has its own strengths and weaknesses, and your investment decision will depend on your financial goals, risk tolerance, and time horizon. Be sure to do your due diligence and consider these metrics when evaluating potential investments. If you found this breakdown helpful, don't forget to hit that like button, subscribe, and ring the bell for more in-depth financial analysis. Until next time, happy investing!